the shock that broke the market. On January 1st, 2025, China did something that sent shockwaves through the global silver market. They locked down their silver supply under state trading export controls. Translation: Beijing told the world they were prioritizing domestic needs. Analysts predicted shortages. Industrial manufacturers panicked. Silver prices started climbing. But then in October 2025, just 9 months later, China did the unthinkable. They exported 660 tons of silver in a single month, the largest export volume on record, straight to London, the exact market they were supposedly cutting off. This was not a policy change. This was not a gradual relaxation. This was an emergency dump, and it failed spectacularly. The paradox: nobody expected. Despite flooding the market with 660 tons of silver, prices did not crash. They did not even slow down. Instead, silver hit 66.6 in all year 21 per ounce. In December 2025, the highest price in history. Think about that for a moment. China dumped the equivalent of 21 million ounces into the global market, and prices went up, not down. So what is really happening here? Why did China reverse course so dramatically after locking down their supply? And why did their massive supply injection completely fail to bring prices down? The answer is not what you think. And what I am about to show you reveals a crisis far bigger than a simple policy reversal. What China actually did. In January. Let me rewind to January 2025 and explain what China actually announced. Their Ministry of Commerce declared that silver exports would now require state approval, the same framework they used for rare earth metals, a system where Beijing can turn the tap on or off whenever they want. The message was clear. China was prioritizing domestic needs over global supply. Their solar panel industry, which produces over 80% of the world's solar panels, needs massive amounts of silver. Each panel requires about 20 grams of silver paste for electrical contacts. With China installing record solar capacity in 2025, industry analysts expected Beijing to hoard every ounce they could get. But here is where the official narrative completely falls apart. The policy that made perfect sense. China's January export restrictions looked entirely rational at first glance. They were securing strategic resources for their industrial base. Solar panels, electric vehicles, electronics, all of these require significant silver, and China dominates global production in every single one of these sectors. Western analysts nodded in agreement. Of course, Beijing would lock down silver. It made strategic sense. Protect domestic supply, fuel the green energy transition, maintain industrial advantage. The playbook was obvious. London traders adjusted their forecasts. If China was pulling 3,000 to 4,000 tons per year out of the global market, prices would have to rise. Simple supply and demand. Some analysts predicted $35 per ounce by mid-year. Others suggested $40 by December if the restrictions held firm. The strange reversal. But by October 2025, something broke. China did not just ease restrictions. They opened the floodgates. 660 tons poured out in a single month, primarily to the London Bullion Market Association. To put that in perspective, China's monthly 5-year average export is around 310 tons. This was more than double that. This was not policy adjustment. This was panic. But panic about what? What could force the world's manufacturing superpower to reverse a strategic resource policy in just 9 months? What could make Beijing sacrifice their domestic stockpile after spending the first half of the year trying to protect it? The answer is in Shanghai's stockpile data. And it is absolutely terrifying. The inventory collapse nobody saw coming. While China was exporting record amounts in October, their domestic silver inventories on the Shanghai Futures Exchange were collapsing. From 3,111 tons in January 2021 to just 780 tons by December 2025. That is a 75% inventory wipeout in less than 5 years. Not a drawdown, not a strategic deployment, a liquidation. And here is the critical insight most analysts completely missed. China was not restricting silver exports in January to build reserves. They were restricting exports because they were running out. And when London's market seized up in October, they had no choice but to raid what little they had left. The London crisis that forced Beijing's hand. Here is what happened behind closed doors in October 2025. The crisis that forced China to reverse course completely. The London silver market, the world's largest over-the-counter precious metals market, was experiencing what traders call a physical squeeze. Inventories were so tight that buyers were paying massive premiums just to get metal delivered. According to analysts at Guotai Junan Futures, the crisis stemmed from rising exports to London combined with elevated industrial and fabrication demand. London was screaming for silver, and the premium they were offering made it impossible for China to say no. Remember, Shanghai silver was already trading at a 15% premium over Western prices earlier in 2025. That spread more than compensated for China's 13% import tax. Chinese traders were already incentivized to import silver, not export it. But when London offered even higher premiums in October, the arbitrage became irresistible, or more accurately, necessary to prevent a complete market breakdown. The emergency intervention. Daniel Gawley, senior commodity strategist at TD Securities, had warned earlier in 2025 that a wave of imports into China would drain the free float away from the West even further. Except in October, the wave reversed dramatically. China became the supplier of last resort. They exported 660 tons to keep London's market from completely seizing up, to prevent the global pricing mechanism from disintegrating, to stop a cascade failure in the physical silver market. But here's the critical detail most analysts missed. This was not a strategic move. This was damage control, an emergency intervention to prevent systemic failure. Why? Because even after injecting 660 tons, roughly $37 billion worth at October prices, silver prices kept climbing relentlessly. The price action that proves everything. On November 26, 2025, spot silver traded above $50 per ounce. By December 18th, it hit $66.21, a new all-time high that shattered the previous record. Think about that for a moment. China dumped the equivalent of 21 million ounces into the market, and prices went up, not down. That tells you everything about the supply-demand imbalance we are facing. The industrial demand, particularly from solar, electric vehicles, and data centers, is so strong that even China's emergency stockpile releases cannot satisfy it. The death spiral mechanism. Let me show you the mechanism that is really driving this market. The death spiral that is already in motion. Stage 1. China imports heavily. December 2024 saw 390 tons, a 3-year high. Stage 2. Domestic solar boom consumes stockpiles faster than imports can replace them. Stage 3. Shanghai inventories collapse, down 75% since 2021. Stage 4. London experiences physical squeeze. Stage 5. China exports emergency supply to prevent global market breakdown. Stage 6. Prices continue rising anyway because the structural deficit remains. And this is not a cycle. This is a death spiral with a mathematical endpoint, and we can prove it with hard numbers that do not lie. The global deficit crisis. According to the Silver Institute, global silver deficits have persisted for 5 to 6 consecutive years. The 2024 deficit was 215.3 million ounces, the second largest in over 20 years. Industry analysts project that if China reduces exports by just 50%, global deficits could exceed 5,000 metric tons annually. But China did not reduce by 50% in their normal operations. In October, they increased exports by 213% versus the monthly average, just to keep London's market functional. And it still was not enough to bring prices down. Here is what that tells us about the true state of this market. The system is structurally broken. Demand from industrial applications has permanently outstripped mine supply. And China, the world's swing supplier, is now scraping the bottom of the barrel. The math that does not negotiate Shanghai's stockpiles. 780 tons and falling every single day. China's production in 2024, 3,200 tons, down from 3,400 in 2023. China's consumption in 2024, 19,000 tons. That is a 15,700 ton deficit that can only be filled by imports or inventory drawdowns. And we just watched them draw down 660 tons in a single month to save London's market. The export restrictions in January were not about hoarding silver for a strategic advantage. They were about survival, about keeping their industrial base functional. Beijing knows their domestic industry cannot function without silver, not their solar panels, not their electronics, not their military applications. But they also know that if London's market seizes up, it triggers a global supply chain collapse that hurts everyone, including China's export-dependent economy. So they sacrifice their stockpile to keep the system running, to prevent the pricing mechanism from completely breaking down. The hard data that cannot be disputed. Let me verify everything I just told you with hard data that cannot be disputed. According to Trading Economics, silver closed at $67.14 per ounce on December 19th, 2025, up 127.54% compared to the same time in 2024. That is the strongest annual gain since 1979, the year silver hit its inflation-adjusted peak during the Hunt brothers squeeze. But this is not manipulation. This is mathematics playing out in real time. China's silver production in 2024, 3,300 metric tons according to CEIC data. China's silver consumption in 2024, 19,000 metric tons according to Indexbox. That is a 15 to 700 ton deficit every single year that has to be filled from somewhere. And China is not unique in this crisis. The global picture is even worse. The global supply collapse. The Silver Institute projects global mine production at 823.5 million ounces in 2024, down 0.8% year over year at a time when we desperately need supply growth. Meanwhile, global industrial demand is hitting record highs across every major sector. Solar panel production is up 20% in 2024. Electric vehicle production is projected to use 100 million ounces by 2030 at current adoption rates. Data center construction is accelerating due to AI infrastructure build-out. Each facility requires significant silver for electrical components. Metals Focus forecasts show the market deficit persisting through 2026 and beyond, driven by rebounding industrial demand, ongoing strength in solar applications, and modest supply growth. Translation: we are not mining enough silver to meet current demand, and demand is growing faster than supply can possibly respond. The Shanghai liquidation. Now layer in China's stockpile collapse, and you understand why the October export was so shocking. Shanghai Futures Exchange warehouse data verified by CEIC shows the complete picture. January 12th, 2021 held 3,111 tons, the all-time high. December 11th, 2025 shows just 780 tons remaining. That is a decline of 2,810 tons, a 75% collapse in visible inventory in less than 5 years. That is not a drawdown. That is a liquidation, a desperate burning of reserves. And remember, this happened while China was implementing export restrictions supposedly designed to protect domestic supply. The restrictions did not work because the deficit is structural, not cyclical. You cannot policy your way out of geology. The rare earth playbook nobody is talking about. If you want to understand where this ends, look at what China already did with rare earth elements, because they are following the exact same playbook. In 2010, China controlled 97% of global rare earth production. They used export quotas to dominate the market and secure strategic advantage. The result? Rare earth prices exploded overnight. The global supply chain restructured at enormous cost. Western countries launched desperate efforts to develop alternative sources. Sound familiar? It should, because we are watching the same movie play out with silver. China currently produces about 3,300 tons of silver annually, making them the third largest producer behind Peru and Mexico. But they consume 19,000 tons annually. That 15,700 ton deficit is filled by imports, exactly like rare earths before the export restrictions triggered the crisis. The critical difference. The difference? With rare earths, China had stockpiles to deploy as a strategic weapon. With silver, their stockpiles are nearly exhausted. Shanghai Futures Exchange data shows just 780 tons remaining as of December 11th, 2025. At their current consumption rate of 19,000 tons per year, that is 1,183 tons per month. The visible inventory represents less than 2 weeks of supply. Even if we assume they have additional off-exchange inventories, which analysts believe exist but cannot quantify, the trend is unmistakable and terrifying. China is running out. And when they run out, one of two things happens, both of them catastrophic for price stability. Option 1, Chinese industrial production slows dramatically. Solar, electric vehicles, electronics all face supply constraints. Option 2, China bids up global prices even higher to secure imports, sparking a bidding war with India, the West, and other industrial nations. Neither option is bullish for price stability. Both options are explosive for silver prices. Why silver cannot be substituted. But here is what makes this crisis potentially more severe than rare earths. You cannot easily substitute silver. Rare earths had alternative materials for some applications. Engineers found workarounds. Silver does not have that luxury in its critical applications. It has the highest electrical conductivity of any metal. Period. No exceptions. It has the highest thermal conductivity of any metal. Period. Physics does not negotiate. It has unique antimicrobial properties that are irreplaceable in medical applications. No other element can do what silver does. For solar panels, you cannot use copper paste. It oxidizes and kills efficiency. Panel performance drops 20 to 30%. For high-frequency electronics, you cannot use aluminum. Resistance is too high. Devices do not function properly. For certain medical devices, you cannot use substitutes. Infection risk is too high. This is why even a 660-ton dump from China could not stop the rally. The demand is non-negotiable. The timeline. Nobody wants to acknowledge. Let me do the calculation everyone is avoiding. The math that reveals exactly how little time we have left. China's remaining Shanghai stockpile. 780 tons as of December 11th, 2025. China's annual consumption, 19,000 tons. Monthly consumption, 1,583 tons. Days of supply remaining, 14.8 days. Less than 2 weeks of visible inventory. Now, before you say China has off-exchange inventories, you are absolutely right. They probably do, held in strategic reserves and state warehouses we cannot see. But here is what we know for certain. Shanghai visible inventory has collapsed 75% since 2021. China exported 660 tons in October, draining hidden stocks to save London's market. And consumption is accelerating, not slowing. Even if China has 5,000 to 10,000 tons of hidden inventory, and that is a generous estimate, we are talking about months, not years, before exhaustion. And every month that passes, the deficit compounds. What happens next? Here's the timeline based on current consumption rates and deficit trends. January 2026. Shanghai stocks likely fall below 500 tons as industrial demand surges post-holiday. February 2026. China either restricts exports again or raises bids for imports, triggering a price spike either way. March 2026. Global spot markets face physical delivery delays as supply chains strain under pressure. Q2 2026. Price discovery breaks as paper markets decouple from physical. Futures contracts settle in cash because metal cannot be delivered. This is not speculation. This is arithmetic playing out in slow motion. The geopolitical wildcard now add this critical variable that changes everything. The U.S. Geological Survey added silver to the critical minerals list in 2025. Why does that matter? Because it enables the U.S. to apply tariffs on silver imports under national security frameworks, the same authority used for steel, aluminum, and rare earths. If U.S.-China trade tensions escalate in 2026, and that is highly likely given the political calendar and ongoing tech competition, silver becomes a geopolitical weapon. China plays their card. We will restrict silver exports unless you back off on tech sanctions and semiconductor restrictions. U.S. responds, we will tariff Chinese solar panels and electronics unless you release silver supply. And caught in the middle, every manufacturer, every investor, every industrial user worldwide watching prices spiral. The price goes to wherever it needs to go to destroy demand. And with solar, electric vehicles, and AI infrastructure all requiring silver, that price might be much higher than $66. The price targets. Nobody believes yet. Technical analysts are looking at the gold to silver ratio for clues about where we are headed. Current ratio, 65 to 1 as of December 2025. 80-year historical average, 60 to 1. Crisis period average, 40 to 50 to 1. If gold stays around $2,300 per ounce and the ratio reverts to 60 to 1, silver should be at $71.67 per ounce. If the ratio compresses to 50 to 1 in a panic buying scenario, silver should be at $86 per ounce. But those are equilibrium calculations. They assume rational markets, orderly adjustment, patient participants. What if this is not rational? What if China's stockpile exhaustion triggers a genuine supply emergency? In 1979 to 1980, silver went from $6 to $50 in just 12 months. A 733% gain driven by the Hunt Brothers corner. In 2025, silver went from $29.50 in January to $66.6 in December. A 123% gain in 11 months. If the rally continues at even half the pace into Q2 2026, we are looking at $95 to $105 per ounce. And analysts tracking Chinese commodity policy suggest this is entirely possible. What to watch in coming months? Here are the specific indicators that will tell you if this crisis is accelerating. January 2026. Monitor Shanghai Futures Exchange inventory every week. If it drops below 500 tons, we are entering crisis territory where emergency measures become likely. February 2026. Watch for Chinese export license approvals. If they tighten again after the October emergency release, it confirms stockpile exhaustion and signals desperation. March 2026. Track physical premiums in Shanghai, London, and New York. If premiums exceed 20%, the paper markets are losing control and physical scarcity is taking over. Q2 2026. This is when the math breaks completely. Either China finds new supply sources, which is unlikely given global mine production trends, or prices spike to demand destruction levels. The institutional players already know this. They are positioning, while retail investors are still trying to understand what is happening. JP Morgan paid a $920 million settlement in 2020 for manipulating silver markets. They understand the long-term supply dynamics better than anyone. Central banks globally bought over 1,000 metric tons of gold for the third consecutive year in 2024. Silver is following the same safe haven bid as smart money diversifies. The final warning, China's 660-ton October dump, was supposed to calm the market, to restore confidence, to bring prices back to earth. It failed completely because you cannot dump your way out of a structural deficit. You cannot export your way out of geology. You cannot policy your way out of physics. The question is not if silver breaks $100. The question is when, and whether you will be positioned before the crowd realizes what is coming. Shanghai's stockpile, 780 tons and falling every single day. Global deficit, 6 consecutive years and 6,695 tons annually. Time remaining, months, not years. The math does not care about your opinion. It does not care about skepticism or hope or fear. It only cares about supply and demand. And right now, demand is winning by a landslide.